Welcome to Shivkumar classes. Today I am covering the topic on valuation of goodwill. This is the common topic for second Bcom, second BBA, CS, CA, CMA and various other courses. Now, what is the meaning of goodwill? Goodwill is, in simple meaning, it is that name and fame of the business. To what extent there is the famous of the business? It leads to an extra earning capacity of the business, because the business will maintain its good name and fame in the minds of the customers, so that the customers coming to the organization, concern it is more, so that their earning capacity of the profit will be more. So that is the meaning of goodwill. Now coming to mainly to the working out of the problem. Methods of valuation of goodwill. There are 6 different methods or it is given. This 6 different method, let me subdivide it is into 2. The first 1, 2, 3 we call it as the simple profit method. Average profit method. First one is the average profit method. And second group I subdivide it is into the super profit method. First one is the average profit method and another one is the super profit method. This average profit is subdivided it is into 3. First one is the simple average period. Simple average profit. Second one is the weighted average profit, and third one is the capitalization of average profit. Now, what is the difference between the simple average profit and the weighted average profit? In simple average profit is the first year profit. The first year profit and second year profit, when we compare that, the first year profit will be more, second year profit will be less, and third year may be more or less. It means that the profit for every year will be in zigzag, that is maybe increase or decrease. But in weighted average period, average profit method, the profit will be into the increasing trend. That is the most important difference between the simple average and the weighted average. And capitalization formula is entirely different. Coming to super profit method, even in this also it is subdivided it is into 3. First one is the super profit method, second one is the capitalization of super profit method, and third one is the annuity method. And what is the speciality under both the cases? It is that in case of simple average profit also, if you learned one method, remaining 2 methods will be applicable with the same following procedure. Even in the super profit method also, if you learn the super profit method and learning of the capitalization of super profit method and annuity method, both will be it is into the continuity of the super profit method. So with the following information, let us enter it is into the working out of the problem. In this video, first one I am working out on the problems on average profit method. Under this problems on simple average profit method, 3 steps we need to follow. What are the 3 steps? First one is calculation of adjusted profit. Adjusted profit, in otherwise it is called as the future profit. And second one, we have to calculate the average profit, and third one only we have to calculate the goodwill, calculation of goodwill. There are 3 steps to be followed. The very first one is calculation of adjusted profit or future profit. Second one is the average profit. Third one is calculation of goodwill. Here the big process here, it is the calculation of adjusted profit or future profit. There is a format in this. And the next one is the average profit. In this average profit only, we subdivide it is into two. One, it is the simple profit, simple average profit, and the second one is the weighted average profit. What is the simple average profit and the weighted average profit? When the profit of 1 year with the another year, if it is into the fluctuation, maybe increase or decrease, under that situation we will follow the simple average profit. But in terms of this weighted average, the profit will be always into the increasing trend when compared to the another year. Therefore, under that situation, we will apply the weighted average profit. So, what is this weighted average profit? Under this weighted, for the first year profit will give weightage 1, second year profit weightage 2, third year profit weightage 4, fourth year profit weightage, like that 1, 2, 3, 4 we will keep on giving that, and total of this weightage and the profit of every year we will multiply. Profit into weightage we will multiply, and we will get the total. For example, you get 1 lakh rupees. That 1 lakh rupees we will divide it by 10 weightage, 1, 2, 3, 4, 10 you get. When we divide it by 10, you get some 10,000. That 10,000 we will call it as the weighted average profit. Yes, for understanding purpose this has been given. And the third one is calculation of goodwill as per the instruction. Now coming to what is this adjusted average profit or adjusted profit or future profit? Very simple. For example, some 3 to 4 year profit will be given, that we have to add it here. Now I am showing with the one single column. When we are doing the problem, if 4 year profit is given, we will add 4 columns. 3 year profit means we will add 3 columns. 2 year profit means we will take it as 2 columns. Yes. The format here it is net profit. With this you can see that add and less. 2 entries are there to add and 2 entries are there to minus. What is this add? This add it is when my profit want to increase. When my profit want to increase, very simple, that add expected profit in future. Expected profit in future. That is the meaning. So when profit is there in future, my net profit will increase. Then quite opposite is that. What is this less? Expected expenses in future. Expected expenses in future. For example, what will be the expected expenses? Expected profit may be will be given in the question. In future we are expecting that this will be the profit, and in expected expenses what will be there? One, it is the expecting of manager salary, expecting of manager salary, or expectation of depreciation, or expectation of insurance, expectation of insurance, like that any other expenses will be given. All this it is expecting. The first one it is I have shown, it is the expected. Then what is this second one? Second one already done by the concern, which has been already done by the concern. Now expenses made, expenses made, but that expenses are, it is the abnormal expenses, abnormal expenses. What is that abnormal expenses? Actually, that is not the day-to-day expenses of the concern, which is irrelevant to the business. That expenses has been shown already. Because of that expenses, the profit has been decreased. For example, let me give an example. Here you see that my business is the rice business. Any profit earned or loss on this rice business, I can show into the profit and loss account of this concern. But what I made, I have very much crazy on the horse racing, or I have very much crazy on the betting on these activities, or else any other abnormal loss like fire occurred into the business or some theft occurred into the business, all that it will not affect the my day-to-day earning of the business. So what happens that like this horse racing expenses, betting expenses or fire loss expenses, if anything which has been already deducted, you have to add it into this one. This is abnormal expenses and losses, right? In the same manner, opposite of that one expenses, I would have included some of the incomes. That incomes also I have to minus it. In the same manner, I would have earned some profit on horse racing, earned some amount on bettings, all that I would have included, or profit on sale of asset, profit on sale of assets, or interest on investment, interest on investment. Like that, any other incomes I would have included, because all that it is not earned through my rice business, it is apart from the rice business. So if I minus all these things, the final answer what I get, it is called as the adjusted profit, or the, yes. Now let me explain one problem. You please see that it is on imaginary figures. Imaginary figures. Yes. Now net profit of ABCD concern for the past 4 years are 40,000, 25,000, 35,000 and 60,000. This is for 4 years. The first next point is that the profit of the third year includes interest on investment rupees 30,000. This is abnormal income. This is not earning on my rice business. Therefore, you have to minus this one. And the next one is the profit of fourth year has been decreased. You can see, you can do this problem with the help of increase and decrease only. Increase means minus, decrease means plus. The profit of fourth year increased because of decreased because of betting made in horse race. 15,000. Horse race is not my business. So this is apart from my rice business. So other expenses have been shown, it is into the rice business. Therefore, because of this 15,000 has been decreased, my profit has come down. So that I need to add it. So one minus entry, one plus entry. And next one is the goodwill is to be calculated at 2 times of average profit of last 4 years under average period method. It is an information. And apart from that, I have included one point extra, this expected expenses. Expected expenses means what I should do, minus insurance of stock has to be insured rupees 500 per annum. So 500 per annum I have to minus from the profit. And the next one is the manager salary rupees 300 per month is given. 300 per month means that I need to do it as 300 into 12 is equals 3,600 per annum. Now all these explanations, let me show it into the once again while working out of the problem. Yes. The very first one is the net profit. First year net profit is 40,000, second year 25,000, third year 35,000, fourth year 60,000, as it is given there. 40, 25, 35, 60. And next one is, it is given the profit of third year includes interest on investment 30,000. In third year I have to minus this 30,000. My third year profit I have to minus 30,000. Yes, what it is called as less interest on investment. When I minus this, I get 40,000, 25,000, 5,000, 35,000. By mistake, it is 35,000 and 60,000. Adjustment number 1, it is over. That is point number 2. Next, coming to point number 3. Profit of fourth year decreased is given. Decreased means I have to add it back. So, add. Loss on horse race. Loss on horse race. Dash, dash, dash 15,000. Therefore, the last year profit is actually 75,000. Yes, sorry, this is 35,000 minus 30,000. It is 3,000. Sorry, 5,000. 5,000. 25,000. 40,000. Right. Yes, 5,000. Now, after this, let us see what is the next point. The next point, it is the expected expenses. Insurance 500, manager salary 3,600. Now, less insurance. Per annum means you need to consider for all the years. 500, 500, 500. Yes. Now, 40,000 minus 500, you get 39,500, 24,500, 4,500 and 74,500. With this, we have to minus expected manager salary. Expected salary. You get 3,600. 3,600. 3,600 and 3,600. Yes. Now, yes. After minusing this 3,600 from each and every amount, the final answer what I get, it is called as the adjusted profit or future profit. It's also called as what? Future profit. Yes. Step 1 is over. Now left over is that we have to do the step 2 and step 3. Now coming to step 2, calculation of average profit. Now in step 1 we got that adjusted profit. No, with that adjusted profit we have divided by number of years. Overall, how many years profit they given? 4 years profit. In first year, if you see that we got 35,900, 20,900, 900 and 70,900. I am making total of all these things. 35,900 plus 20,900 plus 900 plus 70,900 all divided by 4. Now I have to make the total of these 4 profits and I have to divide it by 4. Now this concept only we call it as the simple average, because the The profit from first year to second year has been decreased. Again from second year to third year it has been decreased, and from third year to fourth year it has been increased, so that we cannot apply the weighted average period method. This is the concept of the simple average profit method. The total of this 4-year profit we get 1,28,600 rupees we get it is. Now this 1,28,600 divided by 4 is equals 32,150. This 32,150 is called as the average profit. What average profit it is called as? Simple average profit. Yes, simple average profit. And the next one I have to calculate here, it is the goodwill. Goodwill is equals 2 times of the average profit of last 4 year. It was mentioned. I'll show it is into the question. Now we can see that goodwill is calculated at 2 times. This is the most important thing. 2 times of average profit of last 4 years. Now I have divided by 4. This 4 only I have divided by 4. Now I have to multiply this by 2. So therefore this 32,150 what I got, that has to be multiplied by 2. Then I get 0, 5 2s are 10, remaining 1, 2 1s are 2, 2 plus 1 3, 2 2s are 4, 2 3s are 6. See, 32 has become 64, 150 has become 300. 64,300 rupees is the goodwill. Under which method? Average profit method. Yes, that's it about this problem. And another method is left over, it is the super profit method. I'll show that it is into the another video.